Hello and welcome to tonight's Hutchings webinar, how to maximise the sale price of your pharmacy in London and the South East. Now, given the title, we'll obviously be addressing the subject matter throughout, but tonight we will also be talking about the impact of recent changes in government policy and the budget on pharmacy. Our expert panel today, who you can see hopefully around me, are Paul Steet, Associate Director of Hutchings Consultants and author of all Hutchings Market Reports. Hello, Paul.
Good evening, Sam.
Hammad Naveed, Partner, and Reena Popat, Managing Partner of Carter Bond Solicitors. Hello, Hammad and Reena.
Hi there. Hi.
Hi, everyone. Hi.
Atif Butt, Senior Accountant at the pharmacy dedicated accountancy firm Hutchings Accountants. Hi, Atif.
Hello all.
And we also have a special guest speaker tonight, Gareth Jones, Director of External and Corporate Affairs at the MPA, who'll be joining us partway through tonight's session. He couldn't quite make it for the beginning, but he will be talking about some very interesting issues around the new contract and government policy and budget and how things are looking from his official body perspective, which I'm really looking forward to hearing. So make sure you stick around for that. I'm pleased to say that we have a significant amount of content to deliver this evening, so I won't hold things up much further, except to say there will be a Q&A at the end of the event. So if you have any questions that pop up during any speaker's presentation, please just click on the Q&A button, which should be at the bottom of your video window now. You can check that. And you can submit your questions there anonymously, and we will then pick up as many as we can in session at the end of the event, and any that we don't get to, we'll follow up with you directly in the next working day or two. And so I think if everyone else is all good, we'll move on to section 1 with Paul Steet. Team, if everyone else will... oh, you've already done it. Great. Perfect. Paul, over to you.
That's great. Lovely. Thanks, Sam. Thank you. I'll just share my screen. Bear with me. Okay, so hello, everyone. Welcome to our webinar, Selling Your Pharmacy for All It's Worth. As Sam just mentioned, this evening's webinar will include presentations by Reena Popat and Hammad Naveed of Carter Bond Solicitors, who are renowned and experienced legal advisors in the pharmacy sector. Atif Butt, Senior Accountant at Hutchings Accountants, and myself, Paul Steet, representing pharmacy sales broker Hutchings Consultants. And Mr. Gareth Jones of the MPA. The Hutchings and Carter Bond presentations are designed to provide you with both an overview and insight into the key components of a pharmacy sale, which you should be aware of and factor in if you decide to sell in the future. In respect of Hutchings Consultants, we are the largest independent pharmacy-only agent in the UK, having operated in the sector for around 20 years now. Our team of 9 directors and consultants have over 130 years combined experience selling pharmacies of all sizes across England, Scotland and Wales, and have been approved and recommended by the MPA since 2005. We also work very closely on a day-to-day basis with our sister company Hutchings Accountants, who also specialise in pharmacy. As a quick overview of my presentation this evening, I will cover the current market, including which groups of buyers are most active, Goodwill values and valuations, sale timescales, briefly focus on profitability, touch on the preparations you can make now in readiness for a sale, and briefly explain the 6 steps involved in taking a business to the market and finding a buyer. Each of these important topics could quite easily command a full webinar of their own, but as time is limited today, I will focus solely on the key points. So let's start by taking a look at the current market. As you'll be aware, the disposal of Lloyds pharmacies over the course of 2022 and 2023 introduced over 1,000 pharmacies to the UK over a relatively short period of time, significantly unsettling the market across all parts of the country. The huge uplift in opportunities, many at very attractive prices, distracted potential buyers away from independents. As Lloyds sales have now completed, the market has returned to a degree of normality over the course of this year. The disposals generated a spike in demand from buyers who were keen to take advantage of the wealth of new opportunities and resulted in an 84% increase in new buyer registrations at Hutchings in 2023 compared to the previous year. Many of the pharmacies were sold to first-time buyers who now, having gained a foothold in the market, have plans to acquire further when they have the financial ability to do so. Since the start of this year, new buyer registrations have returned to the levels seen of those in previous years. Although the volume of pharmacies for sale has reduced, a number of smaller group and corporate disposals have entered the market, which has buoyed the number of opportunities for potential buyers to choose from. As a result of the choice available, buyers are generally taking longer in their buying decisions, owing to a desire to explore the market more fully. Overall, despite well-publicised financial pressures within the sector, buyers' confidence generally remains positive, and we're regularly reviewing or receiving offers on pharmacies we're marketing. So you may be asking yourself, who is buying currently? If we look first at the sales that are completed in London so far this year, first-time buyers have led acquisition activity, purchasing about 50% of the pharmacies Hutchings has sold. Existing owners with one shop looking to expand further have followed on the heels at 33%, with group owners accounting for about 17% of the remaining deals. Compared to the previous year, first-time buyer acquisitions have fallen by around 17%, which may be due to the Lloyd's effect, but we've also seen an uplift in this group of buyers encountering issues with securing bank funding for target businesses. If we look at completed sales in the wider South East region, excluding London, we've seen an increase in first-time buyers joining forces with more experienced group operators, which has helped overcome issues around funding. Again, first-time buyers have led acquisitions, with group owners and existing contractors sharing the remaining deals equally between them. Interestingly, first-time buyer acquisitions in this region have increased by about 40% this year. Let's take a look at Goodwill values and Goodwill valuations next and see how values are performing currently. Now, we could allocate the whole of this presentation to this subject alone, but as I mentioned earlier, I wish to focus on some of the key points only. When undertaking a valuation, there are many factors a professional agent needs to consider, including profitability. The factors having greatest impact currently on this include increased locum costs, which are now impacting profitability in the accounts we're reviewing, staff salary increases, and the various pressures associated with inflation, such as the cost of utilities, fuel, and other cost of living expenses. One factor which has a heavy bearing on profits and goodwill valuations and values achieved is the gross profit percentage margin the business is trading at. I'll cover this area again shortly. So what factors are affecting goodwill values? As already mentioned, the oversupply of pharmacies in the market last year created a significant imbalance in supply and demand, delivering more choice for buyers. This ultimately led to some downward pressure on goodwill prices achieved across the board, as interest from buyers for each opportunity was diluted. Business profitability has grown in increasing importance as profits have come under pressure. Many buyers concerned about their ability to service loans and develop a business further have adopted a more cautious approach when submitting offers. The recent introduction of the Pharmacy First scheme in England has been a welcome boost to most sellers and injected some confidence to potential buyers as a further revenue stream to capitalise on. It's a welcome injection of much needed income to the sector, but will take some time to feed through as income in the accounts before it can really start to influence goodwill values to a significant degree. One of the most influential factors to impact values has been the steep rise in buyers' borrowing costs, as the UK government and Bank of England have sought to fight rising inflation in recent years. This Bank of England graph illustrates how relatively stable the base rate of interest was until around the beginning of 2022, when it started to escalate rapidly. The knock-on effect of the rate increases has meant pharmacy buyers have faced increased loan costs, causing many to become more cautious with their offers as a result. With the rate of inflation stabilising and recent reduction in the base rate to 4.75%, we hope to see a period of continuing rate reduction going forwards. However, the current micro and macroeconomic climate suggests it may be some time yet before we see rates falling substantially. If we take a look at the average pence in pound achieved for independent sales in both London and the South East, they compare favourably to average values achieved elsewhere in England, but we've seen a slight reduction this year against the previous 2 years' figures. A combination of factors including pharmacy funding pressures, corporate disposals, bank funding and inflation pressures, to name but a few, have had an impact, but it's important to point out that these are average figures. And as each pharmacy business is unique, prices achieved will vary, with some selling below the average and some above. I can't emphasize enough how important it is that you speak to us if you're considering a sale, in order that we can properly evaluate your business to ensure you're achieving the best price the market is prepared to pay. Next, we'll take a look at sale timescales. So, with all the activity in the market over the last couple of years, have sale timescales changed? Is it taking longer for a deal to complete? We'll briefly look at asset sales and share sales, the NHS, and finally banks. In recent years, over 50% of sales are transacted as limited company share sales, but due to the high number of corporate disposals, this figure has fallen below 30% as most deals are completed as asset sales. At the start of 2022, an average timescale for an asset sale to complete from the point an offer is agreed and heads of terms issued was around 6 months. Over the course of last year, the same period has extended to between 6 to 9 months. Limited company share sales can potentially be more complicated, but usually avoid the need to apply to the NHS for fitness to practice and change of ownership, which can save time in the long run. Average timescales for completions in 2022 was around 4 months, but this has now increased to between 4 and 6 months, largely due to work volumes and banks affecting timescales. Although asset sales are usually less onerous than company share sales, they require the NHS change of ownership approval and also fitness to practice approval as well sometimes. High volume of applications has placed significant workload pressure on the NHS local area teams, whose role is to evaluate and approve them. An important change to the regulations in October this year removed the need to contact applicants' nominated referees for a reference for fitness to practice applications, which should hopefully speed up the process process as we move forwards. Commonly, many potential sellers ask if the banks are still lending the pharmacy. The short answer to this question is yes, they are. Approximately 98% of pharmacy deals we transact are bank funded, so their support is crucial to ensure the market keeps moving. The rapid uplift in transactions last year particularly affected banks and coincided with their increased scrutiny of loan applications. Their workloads have started to return to more manageable levels once more, and they seem to be coping better, but sale timescales generally remain elongated when lenders are involved due to their more onerous due diligence procedures and checks. The banks have generally become more cautious in their approach to lending the pharmacy, and to ensure the target business offers good ongoing security for the loan, are stress testing loans at higher interest rates between 2 and 4% above the Bank of England base rate. Buyers are also expected to contribute high deposits of between 20 and 30% of the sale price. In light of the current financial pressures within the sector, we expect this to continue for the foreseeable future. If you're not quite ready to sell just yet, we strongly advise you focus on improving your business profitability. This will make your business more attractive to the market and will maximise your goodwill sale price. A business quote which, in my view, reflects the current market is the one you see here. Turnover is vanity, profit is sanity, cash is reality. Whilst a high turnover business can initially be attractive to buyers in the marketplace, low profits can potentially curtail interest from some buyers and adversely affect the goodwill value achieved. The sales market has changed significantly in the last 2 to 3 years, and both buyers and banks have never been more focused on the profitability of the target business. The ability of a business to turn a healthy profit could heavily influence both the valuation and its saleability in the current market. I'm not going to be so bold as to tell you how to run your business, but will simply feedback on what we see during our work and the conversations we have with many successful owners. We'll take a look at a quick look at the 3 key areas which can hugely influence profitability: business costs, gross profit margin, and services. For most businesses, we review the greatest expense they have are staffing costs. Wage inflation, statutory wage increases, and locum costs, together with the need to provide a greater range of services, have taken a toll and now account for an average of between 17 and 20% of turnover once pharmacist costs are included. This has risen markedly from the average of 12 to 15% commonly seen in previous years. As you will all be acutely aware, other business costs have also increased, and we strongly recommend you regularly review them in order to mitigate the impact on your bottom line profit as much as possible. Most buyers are now heavily focused on profitability and are tailoring their offers accordingly. In the face of continuing funding pressures, we expect this focus to continue for the foreseeable future. Having assessed our completed independent sales, the current average profit margin in London is around 33% and 32% elsewhere in the South East. However, in some recent pharmacy valuations we've undertaken, it's evident margins are increasingly coming under significant pressure in many businesses. An increase or decrease in margin can potentially have a drastic impact on profitability. We're aware, of course, of the challenges owners face around the supply and cost of drugs, as well as the remuneration issues that are currently present. But our strong advice to all potential sellers, though, is to maintain or develop a sharp focus on the buying aspects of the business to offset as much as possible the prospect of any potential fall in margin. It's been notable to see an uplift in the number of businesses reporting in their accounts margin falls of between 5 and 10% compared to the previous year. For many sellers impacted by this issue, it can come as a surprise as to the degree it can affect their goodwill value. To demonstrate this briefly, take a look at the example of two profit and loss accounts. The turnover and expenses are exactly the same on both, but the left-hand account has a 32% margin, whilst the right-hand account has a 27% margin. The differing margins have resulted in two quite different gross profit figures. If we follow this down to the bottom line, you'll see that once expenses of just over £326,000 on both have been deducted from the gross profit, the left-hand account has a higher adjusted EBITDA or net profit outcome compared to the right-hand. Once we apply, say, a typical 7 times multiplier to the EBITDA figure, you can see the stark difference in theoretical value. A 5% difference in gross profit margin has potentially affected the sale price by around £530,000, which I'm sure you will agree is a pretty significant sum. This is a very simplified version of a valuation we undertake, but it's important to highlight here that Hutchings don't just rely on this method of valuation alone, and will sometimes incorporate pence in pound valuations as and when it's thought appropriate to do so. The next area of increasing importance to both sellers and buyers alike is the service potential of a target opportunity. First-time buyers are aware more than ever that they need to look at services to supplement dispensing income, and I focused on this key area when contemplating submitting an offer. Other buyers, such as group owners and existing pharmacy owners, are even more acutely focused on this, having embraced and developed services within their existing operations. Generally, a sole or heavy reliance on dispensing income now appears to present a potential risk for many contractors, and the introduction of services as another revenue stream has increasingly become a priority for many owners. Very experienced North West England group owner recently commented to one of my colleagues the following: minimum wage increases and the shortage of trained staff has increased our costs significantly in the last few years. Business is tough, but most of our branches are in areas where the volume of items and footfall is quite high. And with our recent acquisitions, the potential is also very good. We focus heavily on services which help us plug the gap in the reduction in profit from dispensing activity. Another contractor with a group of 3 branches in London recently commented to me that in his mind, he now views his dispensing income as paying the bills, i.e. his operational costs, and his services income as his pay. We now regularly receive similar comments from many contractors around the UK. So some of you may be considering coming to the market in the near future and possibly starting to think about how you can best prepare. Your time has many demands, but if you can allocate some of this to planning and preparation, you should ultimately achieve a smoother, less stressful sale in the long run. Apologies to my fellow presenters, as I may overlap with some of the same areas that Reena, Hammad and Atif will mention as well, but I'll briefly touch on some of the most common issues we see arise during sale transactions. Firstly, as mentioned, both the buyers, their accountant and solicitor will need to conduct their legal and financial due diligence. If you haven't sold before and have owned your business for many years, you may find the amount of information requested during the early stages of the sale a little daunting. When you're ready to sell, both Carter Bond and Hutchings can provide you with a detailed list of the typical information you'll need to provide. My recommendation to you is to make a start on compiling what will be required from you over the course of the period of the marketing, as opposed to waiting until a buyer is found. A common issue we see is FP34 statements in the wrong trading name. Sometimes it can be amended swiftly with a clerical change, but sometimes it involves the seller having to submit a change of ownership application and possibly a fitness to practice application as well, which can take many months to complete. I recommend checking the address at the top of your statement to ensure it's set up in the correct trading name. Accurate accounts. With lenders expecting to see comprehensive and accurate accounts information, you need to ensure your accounts are easily read and understood. If selling multiple branches or selling branches out of a group, be prepared to supply split profit and loss accounts for each branch. Leasehold issues can either delay a sale or, in worst case scenario, derail it completely. Common issues include leases in an incorrect trading name or short leases, by which I mean less than 10 to 15 years. If you feel your lease could potentially be problematic, I recommend you speak to us or an experienced pharmacy solicitor such as Carter Bond, who can guide and assist you. Finally, in the run-up to a sale, you need to build your team. Both Hutchings and Carter Bond have the necessary knowledge and experience in pharmacy sales to steer you through what can be, for many owners, a potentially daunting process. We're here to guide and assist you and to maximise your return from your years of hard work. Okay, let's now move across and look at the 6 steps we take when selling a pharmacy business. So step 1 is the specialist valuation. Step 2, the confidential meeting. Step 3 is preparation of sales literature. Step 4 is identifying quality buyers. Step 5 is competitive offers. And finally, step 6, the legals. Okay, so we'll take a look at the specialist valuation first. Before we can start the marketing, we need to establish a value for your business and recommend a marketing price. In order to conduct the valuation, we typically request copies of the latest accounts, recent FP34s, staff information, and recent OTC income figures. We review all the information supplied and produce an adjusted profit and loss similar to that you saw a little earlier. This establishes an EBITDA figure. We then calculate the value by adding a multiplier, and at the same point consider any other factors that can affect the value, such as wholesale income and private scripts, for example. To provide a credible valuation for you, a professional agent will always require a certain amount of information to understand your business. Next in the process, we have the confidential meeting. This is an opportunity for the consultant to meet you and spend some time understanding your objectives and discussing any concerns you may have. The meeting normally takes place at the premises once the staff have left for the day, or alternatively, if this isn't possible for any reason, we can carry out a mystery shop exercise then meet you off-site at a suitable venue. During the meeting, we discuss and agree the marketing strategy, and it's another opportunity to answer any queries you may have. Step 3 in the process is the preparation of the sales memorandum. Our sales brochure is designed to be eye-catching to potential buyers and covers the most salient points of the business, with a focus on demonstrating profitability and potential. The marketing only commences once you've viewed and signed off the final document and are happy to move forwards. We also prepare a separate financials pack, which includes copies of the accounts, FP34s, VAT returns, OTC figures, and a copy of the lease if applicable. The next step is identifying quality buyers, in which we can potentially use 2 different sales strategies to achieve this, to generate buyer interest. We have either the off-market approach or fully open marketing. The most common strategy is the full marketing approach, but occasionally we'll recommend to clients a more discreet off-market approach is taken. With full marketing, an initial shortlist of buyers is created from our database of several thousand buyers, which includes first-time buyers right through to the multiples. Potential buyers are then contacted, initially receiving the memorandum of sale, followed by the financials pack if they're interested. We follow up these parties to encourage viewings as a result. The marketing is kept under constant review, and the list of buyers can be quickly expanded if need be. Where we've identified an opportunity for an off-market sale, an approach is made directly to a selected buyer or a handful of selected buyers who we believe could potentially have a strong desire to acquire the target business. Should we be unable to come to an agreement with any of these parties, we can quickly revert to a confidential open market approach if necessary. As mentioned earlier, the off-market strategy is only appropriate in certain situations when a suitable opportunity has been identified. Step 5 is encouraging competitive offers. Sometimes we recommend the seller consider offers on an ad hoc basis as and when they come in, but in most cases, when we feel it's appropriate to set an offer deadline and call in offers, we will discuss and agree this with our client before setting a formal date. To capture the offer and any conditions attached formally, we use an offer template letter to avoid misunderstandings. This is particularly important with company share sales, as they're usually more complicated than asset sales for various reasons. During these discussions, we'll also request proof of funding from the buyer and work to secure a deposit from them as well if their offer is accepted. This is usually around £20,000, but will vary from sale to sale. Following the initial round of offers, we provide some general feedback to buyers before calling in best and final offers. This allows interested parties to fine-tune their bids and helps increase the competition between them. The competition generated allows us to negotiate the best price and terms possible. Once a price is agreed, the final step is moving the sale into the hands of the legal advisors and accountants. I won't go into too much depth about this now, as Reena, Hammad and Atif will cover this part of the transaction in more detail for you shortly. But as your consultant, we arrange for the buyer's deposit to be paid across to your solicitor, who holds the monies in their client account for the duration of the sale. Hutchings then issue the heads of terms to all parties, including the professional advisors confirming the sale. Our role as an agent now changes from one of marketing to that of sales progression, as we liaise with all parties throughout to ensure it's progressing forwards. So that concludes my presentation. After this evening, if you have any questions or would like to discuss a potential sale privately, please don't hesitate to contact me. Whether you're considering selling now, in the next year, or even several years from now, I would encourage you to speak to us as early as possible. We can review your business and work together to ensure we maximise your goodwill value and make the sale as smooth as possible for you. We can offer you a free verbal valuation, a free tax review, and can also arrange a confidential meeting with either myself or one of my fellow consultants at your pharmacy. So thank you for your time. I will now hand you over to my colleague Atif.
Hi everyone, I'm Atif, Senior Accountant at Hutchings Accountants, where we've been specialising in pharmacy sales across the UK for over 30 years. Today we're talking about how to maximise the sale price of your pharmacy in London and the South East. We'll be looking at the 6 main steps of a pharmacy sale, some of the issues we see coming up along the way, and how you can be prepared for them. We'll be looking at reviewing your tax position, the due diligence process, the sale agreement, the legal process, completion, the completion accounts, and paying your tax. Let's start with the first step, reviewing your tax position. If you're thinking of selling your business in the future, it's never too early to start preparing, even if you don't plan to sell for many years. Being properly prepared makes a huge difference, not only in the price you'll get, but also what you'll be left with after paying the tax man. At Hutchings Accountants, we start by reviewing your accounts and tax position to recommend the most tax-efficient way to structure your sale. It's really important to look at this as early as possible, as optimizing your tax position can sometimes involve making changes to the business years in advance of an eventual sale. Getting this right has never been as important as it is now, with a number of risks, changes and uncertainties facing the pharmacy sector and beyond. Recent events such as the COVID pandemic and outbreak of wars around the world have changed our lives and contributed to rising costs in a number of areas. With inflation and interest rates still high, the economy is facing a challenge. We've also seen a change in the UK government, and the budget last month confirmed changes to the capital gains tax rates and business asset disposal relief, or BADR. We'll talk about these in a bit more detail shortly, but in summary, capital gains tax rates have gone up with a median from 10 and 20% to 18 and 28%, and BADR will go up next year and again the following year. There are also sector and market conditions to consider. Paul's talked about the current state of the market, but as we've seen, there are a number of factors that can change things significantly over the coming years. The best way for us to manage these risks is to be prepared. Once you've decided you want to sell your pharmacy, be sure to get specialist advice that takes your individual circumstances into account. This will help you work out the best way to structure your sale and make sure you qualify for BADR where it's available. So let's take a closer look at sales structure. We heard earlier about asset sales and share sales. So which is right for you? To decide on the right structure for a company sale from a tax point of view, we calculate what your estimated tax bill would be from each option, as there's considerable differences. If your pharmacy is run as a sole trader or partnership, the sale will have to be structured as an asset sale. If your pharmacy is trading through a limited company, the sale can be structured as either an asset sale or a share sale. So what are the tax implications of each? And is tax relief available? If your pharmacy is held personally and sold by asset sale, you'll be liable to capital gains tax and may be eligible for business asset disposal relief or BADR to reduce your tax bill. If your pharmacy is held through a limited company, an asset sale would mean the company selling the business and paying corporation tax on the gain. Business asset disposal relief would not be available in that case, and you would be subject to a further personal tax charge when you want to take out the profits from the company. Share sale, on the other hand, only applies when your pharmacy is held by a limited company. It means you'll be taxed personally on the gain and pay capital gains tax. In this case, you may be eligible for business asset disposal relief. So what is BADR? How does it work and what can it save you? Formerly known as entrepreneurs relief, it's a relief that can apply when someone sells part or all of their business. It means you only need to pay tax at a rate which is currently set at 10% on the gain, as long as certain conditions are met. As announced in the last budget, the BADR rate will increase from 10% to 14% from the 6th of April 2025 and to 18% from the 6th of April 2026. Each individual has a lifetime limit of £1 million worth of gains that can qualify for the relief. How does it work? In a share sale, the qualifying conditions are that you need to hold at least 5% of the shares and voting rights of the company, be either an employee or officer of the company, and the company also needs to be a trading company. These conditions have to be met for at least 2 years before the disposal. And what can it save you? Without BADR, if you were to sell your business for £1 million, you'd be liable to capital gains tax at 28%, which is £280,000. But if you qualify for BADR, this would be reduced to 10%, meaning you'd only need to pay £100,000. From April 2025, this would go up to £140,000, and from April 2026, it would go up to £180,000. Now, there are some circumstances where you may not qualify for the relief, but they can usually be dealt with if you have enough time and the right advice. When it comes to BADR, it's important to identify any problems as early as possible so you can take the steps necessary to remedy them. If you are considering selling your pharmacy in the next few years, as Paul mentioned, it's worth thinking about how you can increase the business value before you sell. We recommend getting a professional valuation by pharmacy specialists and working with your accountant so you can identify the key performance indicators affecting the value and how these could be improved over time. Your accountant can also review your tax position to see if there are any issues that might increase your bill and work out how to resolve them and ensure you get the most favourable tax treatment. Looking at this ahead of time gives you the opportunity to map out a list of prioritised targets you want the business to achieve and a timeline over which you want to achieve them. This could be things like reducing stock holding and wastage, improving the business's gross profit margin, or making sure the sale will qualify for BADR. Now, as we've said, preparation is key, and it's worth looking in a bit more detail at some of the things we commonly see in pharmacy sales that can cause problems or present opportunities. We talked earlier about the conditions for BADR. If you have a company with more than one share class, this may need to be looked at, as some of the shares may not qualify for the relief at present. Your company also may not qualify if it owns too many investments or holds too much cash, as HMRC could say that it's not just a trading company and is also engaged in investment activities. As we said before, each individual has a lifetime limit of £1 million worth of gains that can qualify for the relief. So if you've ever sold or incorporated a business before, you may have benefited from the relief and used up some of your allowance. Also, if your sale proceeds are over £1 million, they won't all be covered by the relief, and some of them may be taxed at 28%. Investment property owned by a company can cause problems with BADR, but we more commonly see pharmacy companies that own the trading premises they operate from. Sometimes these may be included in a business sale, but there are cases when the business owners want to take them of the company before the sale, and it's important to take advice on the most tax-efficient way to do this. As well as affecting BADR, the level of cash in the company can have other implications to your sale which may need to be considered. It's not unusual in pharmacy sales for us to see high levels of cash being retained by the company at the point of sale. Buyer may not want to take over the company with such a large bank balance, and in such cases, it's possible to arrange for a cash extraction at completion, where the seller can effectively take out the excess cash, leaving the buyer with enough for their working capital needs. Another important area that's worth considering early on is what you want to take from the business in the form of salary, pensions, and dividends in the years leading up to your sale. It's well worth engaging in some tax planning in your final years of ownership, particularly around dividends, to make sure that you'll end up paying the lowest rate of tax overall on your lifetime earnings. So we've looked at some of the things to consider before a sale, but now briefly talk about what happens once you've found a buyer. Once your potential buyer pays their deposit, the next step is the due diligence process. This gets underway with the buyer's accountants requesting a list of information, which tends to be a lot more detailed in a share sale. As accountants, our job is to work alongside your legal team to make this run as smoothly as possible. The buyers will usually want to go back several years over the company's history so they can be as comfortable as possible. This is very important in a share sale as they are taking on the historical liabilities of the company. Your lawyers will go through the sale agreement with the buyer's lawyers to agree a finalised version. Your accountants will also need to review this from a tax and accounting perspective, suggest any changes to the main terms and covenants, and carefully go through the warranties to make sure the buyers are made aware of any exceptional events or circumstances. You can see how important it is to engage accountants and solicitors who specialise in pharmacy sales to get this bit right. Because pharmacy is all we deal with, and we see so many sale agreements in the course of our work, we know what is appropriate and what is excessive to warrant. And so with our combined experience, we're able to limit your risk. When we review sale agreements, there are a number of things we look at carefully. For example, the proposed method to calculate the net current asset figure, as this will affect your final payment, which we'll talk about in a bit more detail in just a minute. The agreement also sets out the term by which the business must produce the completion accounts and what the procedure would be if the accounts were not agreed by the buyer. We also go through the tax warranties in the agreement very carefully and cross-check them with the company's accounts for the last 3 years to produce a list of facts and circumstances that need to be disclosed to the buyer. The tax warranties are very detailed and refer to numerous statutes from tax and company law. So it's essential they're looked at by an experienced accountant familiar with both your business and pharmacy sales. Putting the time to get this exercise right means you can sign the sale agreement with peace of mind and confidence that your interests are protected. In a share sale, the total amount you receive for selling your shares is made up of the agreed price for goodwill and the fixed assets of the business, or the headline price, and an adjustment for the net asset position of the business at the point of sale. The net asset position is made up of the company's current assets, things it owns or is owned, like cash, stock, and money owed by the NHS or HMRC for VAT refunds, minus the liabilities or things it owes out, like money owed to suppliers or HMRC or any bank loans. If there are more assets than liabilities, an additional payment is made by the buyer for the net asset value. But if the liabilities are more than the assets, a deduction is made from the goodwill payment. When the buyers are happy with the results of the due diligence exercise and the sale agreement is close to being agreed by both parties, a target completion date is agreed for ownership of the pharmacy to transfer from the seller to the buyer. Once the target date for completion has been agreed, we need to provide the buyer side with an estimate for the company's net asset position at that date. Of course, we're unable to look into the future and provide exact figures, so we estimate as best we can, and this then gives the buyer an idea of the net current asset payment they'll need to make in order to complete the purchase. Once completion accounts have been prepared and agreed by both parties several months after completion, final payment can be made for the actual amount due as per the accounts. Next, we come to the day of completion when the pharmacy will actually change hands. This is when the share purchase agreement and other documents get signed and ownership transfers from seller to buyer. From here on in, it's the new owner's job to run the business, pay the staff, and assume responsibility for all of the business assets and liabilities as at that date. It's generally helpful if the completion date can be done at a month end, as this makes it much easier to calculate the position of the business at the point where it transfers. After completion, the next thing we need to consider is the completion accounts. These need to be prepared with extra care and attention to make sure that they're in line with the sale agreement and also represent the closing position as accurately as possible, so you can be sure to benefit from all the profits from your period of ownership without paying for any of the expenses from after this date. Once the accounts are prepared and agreed on this basis, they're sent to the buyer's accountant, and under the terms of the sale agreement, they have a specified period in which to inform us of any disputes or to accept the accounts. Once accounts are agreed, the buyer will release the final balancing payment for the net current assets, which means you've now received full payment for your business. Now let's talk about the final step, paying the tax. The sale will fall in a tax year ending the 5th of April and would need to be reported in your tax return for that year. This would need to be submitted and paid by the 31st of January the following year. So as an example, if you sold your business on the 31st of March 2025, this would be in the 2025 tax year, and your tax return and payment will be due to HMRC by the 31st of January 2026. So how much would the tax be? If you were to receive a total of £1 million for your business and its assets, and you paid professional fees of £50,000, the total profit from the sale would be £950,000. After deducting your annual allowance for CGT, you're left with a taxable profit of £947,000. Now, if you don't qualify for BADR, this would be taxed at 28%, making a total of £265,160. With BADR at the current rate of 10%, the capital gains tax would be £94,700. And if you qualify for BADR and your sale completes after the 6th of April 2025, your tax bill would go up to £132,580. And if your sale was to complete after 6th of April 2026, this would increase to £170,460. So you can see how the timing of your sale can make a huge difference to your tax bill and what you're left after paying it. That's all from me, everyone. Thank you for listening. And I'll now hand over to the team at Carter Bond to talk about the legal aspects of the sale.
Hello, everyone. Thank you so much for joining us this evening as well. So we are the lawyers. There's myself and Hammad and Naveed, and we're from Carter Bond Solicitors. We're going to be talking about the legal aspects of selling a pharmacy. So we'll try and avoid any legal jargon, and we will go through this, and any questions, please feel free to put them in the chat. So a bit about myself. I'm the managing partner of the law firm. I've got 20 years experience. I do a lot of buying and selling pharmacies, as do some of the other team members as well. So between us, we've pretty much seen it all. I'm joined today with my colleague Hammad Naveed, who's a partner as well, and he also assists and heads up the healthcare, particularly the pharmacy division as well. So a bit about the firm. We are a Legal 500 ranked firm. So what that means is that in the country, we're one of the top Legal 500 law firms that can assist with healthcare transactional matters. This year, we've also been ranked in Chambers UK, and also we are recommended partners of the National Pharmacy Association as well. Proud recommended partners, should I say. And we complete a lot of pharmacy transactions over the course of the year. So as I said, we're going to be talking about pharmacy sales and the legal processes. So I will hand over to Hammad.
Hi, everyone. So Atif and Paul have both touched on it. And just to expand a bit further, one of the first legal aspects to consider when it comes to selling a pharmacy is the structure of the sale, whether it's going to be an asset sale or a share sale. For those that have an option between an asset and share sale, Atif has already gone into the tax differences and what impact your existing structure would have. Some other considerations are that for a share sale, sellers often find that it's a clean break. They don't have to worry about winding the business down, winding the company down, closing supplier accounts after completion because they've sold the whole thing to a buyer. From an asset sale perspective, the benefit for a seller would be that whilst they're not selling everything, they actually get to choose to retain certain assets like the cash in the bank, or if they've got any personal items at the pharmacy. Because a share sale is a bit more complicated, a buyer is essentially taking over the seller's liability, there is a bit more due diligence. So from an asset sale perspective, it's seen as a quicker legal process with more limited due diligence. In an asset sale, sellers often find that the stock gets paid a bit quicker as well. And the reason for that is just because there's a much more simpler accounting mechanism after completion. In a share sale, however, because everything stays with the company, like the NHS contract, staff, lease, there's no change of ownership process, there's no change of employer, there's no necessarily a change of tenant. So the legal process from a share sale can actually move quickly as well. In terms of the disadvantages, that's going to be the next slide, Reena. The change of ownership process can take quite a bit of time in a asset sale. So Paul's put down some estimated timescales somewhere between 3, 5, and 6 months. With an asset sale, one of the other disadvantages is that the staff need to be consulted. It's called 2P, transfer of undertakings and protection of employment regulations, which was quite a mouthful and probably why they've got an acronym for it. That process takes a bit of time, and there's always a risk of staff not being happy with a new buyer or staff resigning before completion. So sellers often find that a share sale is a bit quicker because it keeps the process a bit more confidential. On the other hand, because, like I said, the buyer takes on a lot of the responsibility of the seller, there is a more extensive due diligence process, which can have an impact on costs, for example. On that same vein, there's a completion accounts process, which Atif has touched upon. And within that process, once it's finalized, a stock payment gets made. This basically means that in an asset sale with a simpler accounting process, stock can be paid within a week to a month after completion, whereas in a share sale, it could take somewhere between 3 to 6 months after completion. I've mentioned the change of ownership aspect as causing, it takes quite a bit of time. And the easiest or quickest way to explain that is that in a share sale, a buyer and seller simply have to notify the NHS after completion, whereas in an asset sale, a buyer and seller have to seek approval from the NHS well before completion. So for a first-time buyer, that can take a bit more time. So that's something that sellers should consider when they're thinking about the structure, whether it's going to be a seasoned buyer who's got maybe multiple shops. That buyer may already have fitness to practice approval. They may have already gotten change of ownership approval on other shops in the area. And so they might have a quicker time in getting approval than a first-time buyer, for example. I'm just going to hand it back to Reena to go into a little bit more detail on the legal process.
So the legal process can be a bit intimidating, and normally when sellers are selling they're selling for the first time as well. So just to give it a little bit of context, there are three different aspects to it. There's the property aspect usually, there's the actual commercial aspect to it, which is the transactional part, and then there's the lending part. Now, all three have got to kind of happen simultaneously. It doesn't matter if you're acting for the seller or the buyer, all three will happen simultaneously and sort of come to a crossroad at the end, and that's when you'll tie it up. So for example, on the property bits, you may own the freehold and you're going to be granting a new lease, or it might be a leasehold property which you already have, in which case you need the landlord's consent in which to assign the lease as well. So as part of the due diligence process, the buyer solicitors will ask for lots of title information, lots of questions on the property. They're called the CPSEs, and that means the commercial property standard inquiries. That's what it means. And that's when they ask for things like the EPC, the fire risk assessment, all these bits and pieces which we send over to them. Now, if you are granting a lease, then at the same time, they'll want to see a copy of the draft lease as well. And it's usually the landlord's side, so the seller side, that would actually prepare this. Or if it is going to be an assignment of an existing lease, then that's where we would contact the landlord to say, can you give us your consent to assign? And at that point, either we navigate and continue to liaise with the landlord and the landlord solicitor, or at that time, we put the landlord solicitor in touch with the buyer solicitor, but we're copied in the loop, and then they will actually agree the documents themselves. We will then bless them. So there's different processes depending on whether it's a lease assignment or whether it's a new lease. Simultaneously, we will also receive the due diligence questionnaire from the buyer solicitor. Now, if it's an asset purchase, then the due diligence questionnaire is going to be a lot less than it's a share purchase, simply because when you're selling your shares, the buyer is taking everything lock, stock and barrel, whether it's the assets and the liabilities, they're taking it all. So therefore, the questions are going to be a lot more as well. We would be working with you to answer that. So we'd create a data room, an online data room where you can upload all that information. We then make that available to them. So gone are the days where bits of paper are pushed around and sent in the post and things. It's all done very streamlined as well. And we prepare what you call a disclosure letter. We'll talk about that a bit later on, but that's almost, I call it a confessions letter. So you confess everything to the buyer, so then there's no comeback on you as a seller. And Hammad mentioned the 2P process. So that all forms part of the ancillary documents like the board minutes, the resignation letters, stock transfer forms if it's a share sale, and 2P letters. And just a reminder that 2P only applies to an asset sale, not a share sale at all. And then there's a lending side. Now, whilst that doesn't necessarily impact the seller because we don't have to do anything, but we need to make sure that the buyer's ready. Now, we've got to make sure that they've got the valuation, they've got their facility letter, but also their lender and their lender solicitor may also ask various different questions, especially if they're taking security over a new lease or an existing lease. So we just need to make sure that that all coincides. And also, if we are redeeming a loan as well for the seller, we have to make sure that we've got the redemption statements all ready so that when we draw down on funds, we can redeem that and then it's all clean. So all three processes parallel happen together.
So Reena's mentioned the due diligence process, and our friends at Hutchings also mentioned that it's also a three-pronged aspect, where the buyer's financial advisor, the buyer's legal advisor. And it was also mentioned that once you on board with Hutchings or Carter Bond, you'd get a list of all the key documents that you might need to get prepared. This is an example of what that list could look like. So from a financial due diligence perspective, sellers looking to can get their accounts ready, their FP34s organized, all their VAT returns and bank statements in one place so that their accountants can provide that to the buyer side as part of their financial due diligence. From a staffing legal and regulatory perspective, sellers should look at getting all their staff contracts in order. Oftentimes pharmacies end up not having staff contracts because they've known their staff sometimes 30, 40 years, and sometimes it's apprentices, and there always seems to be a feeling that we may not need staff contracts because, you know, we're not that kind of business. But when it's time to sell a business, buyers often expect there to be staff contracts so that there's certainty between what the staffing terms actually are. Something Paul mentioned in his presentation was it's important to check that the contracts are in the right name, that the FP34s are in the right name. So it's important to check that if it's a company sale, that all the insurance policies are in the company itself, so that, you know, a different business isn't actually being insured. Sometimes we see that the NHS contract in a company sale is actually in the seller's personal name. So that's something that needs to be looked at as part of the due diligence process. Compliance certificates are really important. Things like EPCs, portable appliance testing certificates, EICRs, fire risk assessments. It just probably sounds like I'm saying a number of acronyms again. But the idea is that for those sellers looking to complete, hopefully before in the current tax year, it'd be important to get all your compliance certificates ready, because there's those things that your solicitors and your accountants can do, and there's certain things that you would have to go get a third-party surveyor, like a fire risk assessor, an electrician, to make sure that all the wiring is up to date, because buyers, and especially buyers' banks, need to be assured that from a health and safety perspective, the pharmacy is up to scratch. And not having these certificates in place in time can often cause a delay, because sellers then have to go to third parties last minute. And then it's a case of who has to cover the costs. So it's easier if these things are actually managed at the start of the process. So Reena mentioned the disclosure letter is like the confession letter. So the disclosure letter is the seller's opportunity to let the buyer know about any of the issues that there might be with the pharmacy. So if there's any employment issues, any litigation, dispensing errors, the disclosure letter is the best place for that information to be provided. It helps because from a seller's perspective, the more transparent and honest you are, the lesser the chance of a buyer coming back after completion with a claim for, you know, misrepresentation, or, you know, not being provided with the relevant information, or being provided with inaccurate information, for example.
And we touched on 2P as well, and it only applies if you're selling the assets, not the shares. So 2P, from a seller's perspective, it's really important that you share with the buyer and disclose to the buyer all the employment contracts. The number of times where we've sold or helped sell a business and there's no written employment contracts as well, or we've had to work with the seller to quickly put something in place, because this is a legal requirement to have a written contract with your employees. What it also means as well is that the buyer, once the employees are transferred over, the buyer cannot change any of their terms. The buyer must take the employees and the employment contracts as they are. They've got a duty to consult with them. That duty is not only the buyer's duty, but also the seller's duty as well, to consult with them. And what does consult mean? That could mean a letter. It could mean just speaking to them. Unless until you've got over a certain number of employees, you don't need to follow a set process of what that consultation looks like. Another point I should just mention as well is sometimes sellers will increase the employees' bonus or any of their terms, holidays and things. Things like that must also be disclosed to the buyer, because if this comes out as part of the due diligence, or even after due diligence, then there is a risk that there could be a claim against the seller. Not only this time from the buyer, but there could be also a claim from the employee as well, because they have this 2P protection, and they could argue that this were the terms whilst they were working for the seller business, and the buyer has not honoured them, and therefore there's a claim from the employee as well. So it's really important that all the information goes across. Final point to mention on this is that 2P doesn't apply to locums. So locums aren't protected because they're not employees. 2P only applies to those who are employees, so under the PAYE.
So the property aspect is something that we're mentioning separately, although it's part of the due diligence, and although we've mentioned the commercial property standard inquiries, the CPSEs, the reason it's important to set this out separately is because a lot of times sellers ask, how long is it going to take to complete? Sometimes that's like, how long is a piece of string? But the factors that impact timing are things like the change of ownership, sure. The buyer's lending, yes, but also the property side. So for example, I've already mentioned the health and safety certificates, but for those sellers that are, again, looking to complete in the next few months, do you have leases that are expiring? If so, have you spoken to your landlords to negotiate a new lease term? Are you going to get the potential buyer involved in that negotiation? Is the lease currently in your personal name, or is it in your company's name, or is it in a family member's name? All these things need to be looked at as early as possible, because with landlords as third parties, especially where a seller is not actually the landlord themselves, it's impossible to incentivize a landlord to work towards the same timescales. Whilst we're talking about changes in BADR and capital gains tax in April 25 and 2026, landlords aren't concerned about that because it doesn't affect them ultimately. The pharmacy sale, whether it goes through or not, doesn't impact them because they'll still have a sitting tenant paying rent. So because of that, the best advice we can give in terms of completing on time. So the best way to complete on time would probably be to start early.
And some of the key points to bear in mind. So really quickly to go through this. If you are the owner of the freehold and you're going to be granting a new lease to the buyer, you need to consider a few things such as the rent deposit. If it's a first-time buyer or if they've got a limited company, then it's always a good idea to get 3 months or 6 months rent deposit. Also, you need to think about a rent review period, what that looks like. It can be common that there's no sort of one size fits all. It's just down to negotiation and also what happens during the transaction as well. Rent review period, you could have a 3-year period linked to RPI. You could have a 5-year rent review. It just simply depends. Think about service charge, and if there's any communal areas, maintenance obligations. Is the buyer, is the tenant, who's also maybe the buyer as well, are they required to paint the outside? How often? What does that look like? Guarantee provisions as well. So usually if the buyer and the tenant is a limited company, then from a landlord's perspective, and landlord who's also a seller, you would want to think about some personal guarantees from the directors as well, in case there is a default on rent or any of the provisions in the lease as well. And also lender protection provisions as well. So if the buyer is getting bank funding, usual bank funding, then the bank will take a charge over this lease. What that means is there'll be step-in rights. So in the event that the buyer then defaults on their lending, it means that then the bank will become your tenant. From a landlord's perspective, that's good because you've got a great tenant who's now going to pay your rent. So they will want that as well, these protections, and that's what that means. On the agreement side as well, as Hammad touched upon, is from a seller's perspective, once you've sold, you want to kind of go into the sunset and then not think about any comebacks. So you've got to think about your future plans. Are you going to be looking to set up another pharmacy? In which case, you've got to really consider what are the restrictive covenants in this agreement. Does it say that you can't work for a pharmacy? Does it say you can't compete and set up a pharmacy? In what sort of radius and parameters? So that's all up for negotiation. Also, as part of the process, the seller is required to give certain assurances. They're called warranties and indemnities. So certain assurances to the buyer about the pharmacy as well. We would negotiate these as much as we can and qualify them to awareness and time frame and etc. But all of these you need to work through just to make sure that they fall away within a short period of time, usually 12 months, 24 months, sometimes a bit longer as well. The completion accounts provisions. If you're selling the shares in the company, the likelihood is that over a period of time, you may have built up some surplus cash in the company as well. And so how to extract that out. So that's where we'd work with Atif and the team at Hutchings to see how can we extract that out and make sure that's reflected in the agreement as well in the most tax efficient manner as well. And stock payment provisions as well within asset purchase, as Hammad said, quite easy. You know, it's paid within a certain period. There's going to be a stock taker, an independent stock taker, and then that's how that works. But with a share sale, it's slightly different because there will be a net asset adjustment valuation, and then the stock is paid as part of that when the completion accounts are done, usually within 3 to 6 months after completion. So all these points are all negotiation points that we can help you navigate.
So once the due diligence is complete, the property side and the agreement are all tying up together, and we're reaching this stage of completion. Some of the things to think about on completion and right after completion for a share sale. One thing, it's important to understand that the bank account stays the same. So the buyer needs to actually have access and control over the bank account, and the seller needs to come off it. Sometimes that's something very simple where the seller can just log into their online banking and just add the buyer as a signatory. Sometimes it requires a bit more effort, and the buyer and the seller have to go together to the bank and register the buyer as the new authorized signatory. Sellers have to come off Companies House as directors, and they have to notify the NHS with the buyer that the sellers have now resigned and are no longer the superintendents. This is really important from a seller's perspective to have your resignation happen definitely on the same day as completion, because not only would there be tax implications of that not happening, but you also don't want to be responsible, even for a second, for the buyer's period of ownership. We've already mentioned completion accounts and the stock payment, but from an asset sale perspective, something the sellers need to look at is closing their supplier accounts. That's not actually something that should start on completion or after completion. Realistically, it would make sense to get that started about 4 to 6 weeks before completion takes place, because it goes hand in hand with the buyer setting up their own supplier accounts. So more often than not, sellers would introduce the buyers to their existing suppliers, and they would either agree to assign or novate or transfer the seller's existing supplier contracts to the buyer, or they would just cancel the seller's contracts and give the buyer new ones. From a buyer's perspective, they might actually prefer to hang on to a seller's contract and have that assigned to them, because sellers, trading for 15, 20, even 30, 35 years, there's goodwill, there's discounts, there's, bulk buying. There's a lot of goodwill that's generated with the suppliers, and the buyer essentially does not want to start fresh. Another thing to look at is, whereas with a share sale, there's a completion accounts exercise that's normally done between the accountants. In an asset sale, it's called an apportionment schedule, and it's a bit more simpler. It is done a bit more quickly, and it's dealt with directly between the buyer and the seller, because it's not necessary to wait, months for the FP34s to catch up. It's just a case of, waiting for about a month to complete, getting all the meter readings up to date, and then just, seeing who owes what to the other party.
So just to finish off, why use us? A few reasons. We are a proud recommended partner of the National Pharmacy Association. We work on a fixed fee basis and very, very transparent with fees as well. So that will be given to you right at the outset of the matter. We have many years of experience in pharmacy transactions, both buying, selling. We have for individuals as well as groups as well. We have for sellers and for buyers. We have over 480 5-star Google reviews. We're here to build long-term relationships with you as well. So even if you've sold, we'll still be around, you'll still be in contact with us. And we have a client service pledge, which we send to all of our clients, so what they can expect from us throughout the transactions, how quickly we'll respond, who to contact. And also, all matters are partner-led as well, and you're given everybody's mobile number as well, so you can contact them directly. And finally, our contact details as well, so you can contact me or Hammad at any time. Here's our mobile numbers as well, and our email addresses, and we look forward to working with you.
That's great. Thank you, guys. We are now ready to welcome our guest speaker, Gareth Jones. Gareth, if you are able to unmute your mic and unhide your camera, that'd be great. Reena, if you're able to stop sharing your screen, that would also be great. And then I know that I think that Gareth has a couple of slides that he'll be wanting to share. Reena just mentioned at the end that or provided a slide there with her contact details. If you were scribbling them down but didn't quite get to them, fear not. I will send out an email just after following this webinar with everyone's contact details there for you, so you'll have them written down. Okay, great. So Gareth, we have your slides in full screen in front of us, but your camera is still hidden. If you could unhide that would be great, and I can then hide mine and duck off whilst you.
Yes, I hopefully you can hear me. I haven't been able to do my camera myself. I'm getting a message that the host has to put my camera back on for me.
Oh, that's interesting. You must be special. Okay, I've now asked you to start your video.
Try that. Yeah, that looks like it's worked.
Perfect. Okay, Gareth, I will hand over to you, and then after Gareth's segment, I will pick up for a Q&A if we've got time, just for the last few minutes. I know some great questions have come in, so we'll see what we can do. But Gareth, over to you.
Okay, thank you very much, Sam. So yeah, what I'm going to do is give a bit of an external environment update, which I think is important for anyone going through a sale, because obviously the external environment affects the conditions of the market, affects prices, but equally because any buyers will obviously be thinking very much about what is happening in the external environment and what opportunities they may have when they buy into the business. So I'll talk a little bit about the new government, the budget, and generally what I think the key factors at the moment affecting community pharmacy. So we've got a new government in place with some interesting and potentially quite helpful policies for community pharmacy, which is good for potential buyers to be coming into a market where there are potential opportunities. So we've got the new government talking about the community pharmacist prescribing service, so granting more independent prescribing rights where clinically appropriate. We don't yet know the details of this and where this role will go. It's quite likely that it will start off within the pharmacy first service and generally in provision of urgent care, but over the next 3 to 5 years, we might see some long-term condition management, for example, being delivered by community pharmacists through this new community pharmacist prescribing service. Essentially, there's a blank canvas here. The government doesn't really know exactly what the details are of this scheme, but they've got a commitment to do something, and so I think that's very promising for the sector. They are also talking about a neighbourhood health service. Now, on the one hand, there are some concerns when people start talking about polyclinics or some of the old Darzi clinics that actually this might be pulling a lot of healthcare provision into locally enhanced health centres. We're certainly suggesting that the neighbourhood health service should really be about integrating all the local primary care providers and therefore creating new opportunities for community pharmacy to provide more services better integrated into the local health system. The new government is talking about 3 key transitions that they think are really important. Secondary to primary care. They won't be the first government, in fact, to mention any of these things, but certainly they've said trying to get care out of hospital into primary care is a priority for them because it's more convenient for patients and because it's more cost effective, and that should open up new opportunities for community pharmacy because there is no way that general practice can take on all of this work from secondary care without passing some of its work on elsewhere. Community pharmacy is the most obvious place for that work to go. So for people looking to to come into community pharmacy over the next 3 to 5 years. There are potential opportunities there. They're also talking about treatment to prevention, so to try to catch people earlier before they get unwell through prevention. And prevention is another area where community pharmacy already operates, but there's great opportunity to expand. And their other focus is analog to digital, which again, there are a few opportunities for pharmacy to support that drive. Now, the immediate priorities were to sort out access to general practice and dentistry, and that's why general practice and dentistry were called in to see the Secretary of State within days of him taking office. But actually, those problems are still there. It's going to take them some time to make progress on those key priorities. But again, when we can show we can help out the challenges in general practice, it does help us get the ear of government. We've already had the Darzi review, which has been conducted very quickly by the new government. Essentially, it's the diagnosis of what's wrong with the NHS. And Lord Darzi, former surgeon, has concluded that the health of the nation has deteriorated. But quite often, generally, really, we haven't seen community pharmacy mentioned in these sorts of reports. But actually, and we were concerned, actually, Lord Darzi, with his background in hospital, may not see pharmacies as being something he wanted to talk about. But we certainly spent time talking to his team, and we were pleased to see he recognised that pharmacies are one of the great strengths of the health service. But they're now closing in significant numbers due to chronic underfunding. So that's really important that's been recognised, because whilst this report was technically written independently by Lord Darzi, it was cleared politically by the Department of Health and Wes Streeting's advisors. So the new government is happy to accept that there has been underfunding in community pharmacy. And we saw that again in some of the comments put out by government today, which I'll mention a little bit later on. But government now is recognising that community pharmacy has been underfunded and does need more money. Now, how much extra we get is still to be determined. But it is reassuring for the market as a whole that government does recognise that new money needs to be put into community pharmacy. The government's just started the consultation on the new 10-year plan for the NHS. So that's currently running for the next few weeks. And they will then put that plan together. It'll come out in, they're saying spring, which is what governments often say when they want to give themselves lots of flexibility. Could be March, could be April, could even be May, but they come out with a new 10-year plan. We think community pharmacy will feature in that, and that will set out the blueprint really for what is likely to come through in the new contract of the community pharmacy. I mean, I don't expect big changes in the community pharmacy contract until April 2026 at this point, but we should get some idea in that 10-year plan in spring of next year on where the opportunities are for the newly developed community pharmacy contract. And another key element of the new government's policy is their Get Britain Working white paper, recognising there are a lot of working age people who are not currently in work. And I mean, I just mention it here because, again, there are things we can do in community pharmacy to help people get back to work. And that's another string to our bow, really, when we're trying to sell ourselves to the new government and ensure that we can build a strong sector over the next few years. I'll just pick up a few of the other changes in pharmacy that I think are relevant this evening. So the potential expansion to the Pharmacy First service, it got off to a very good start. It's hit the buffers really at the moment because we just can't get the number of patients through. But I think what's important is the structure of the service has been shown to work. The promotion of it has been poor. The support from general practice has been poor. There aren't enough conditions in it. The scope of those conditions isn't wide enough. But the Pharmacy First is seen as a way to deal with the GP access problem in quite a significant way. And that should mean that it gets expanded and new money is brought into the sector. And people should have confidence about that. They're coming to the market. Supervision will be changed. That's essentially agreed now. The regulations just need to go through. And that will mean that there will be more ability to delegate to pharmacy technicians. So pharmacy technicians will be able to take accountability for full accountability for the accuracy of dispensing, and that allows people to think a bit more about skill mix and using different sorts of staff. So helpful regulation there. Hub and spoke, again, those regulations are pretty much certain to come through in, I would say, the next year probably. I mean, we've been thinking hub and spoke would come through in the next year for many years, but we've got a strong indication now that the new government is going to proceed with Model 1 of hub and spoke, which is essentially that a pharmacy can send the medicines off to, or send the prescription off to a hub, the medicines come back to the spoke pharmacy, and then it's supplied from that spoke pharmacy. So supervision and hub and spoke creates some opportunities for efficiencies using technology when people are thinking about how they want to invest in the future. And of course, the growth in independent prescribers in community pharmacy. So getting on for 20,000 out of 60,000 pharmacists are currently independent prescribers. From 2026, there'll be about 3,000 newly qualified every year coming online. And there's all the training that's being offered for pharmacists that have already qualified. So the roles linked to independent prescribers are likely to come online in that sort of 3 to 5 year time frame. We look at Wales. Wales are a bit ahead of us in England. They've already got well over a quarter of all pharmacies in Wales with an independent prescriber on site and able to deliver additional services. So again, something that's positive for community pharmacy, positive for the sector, should increase confidence. So budget, just to run through very briefly some of the changes in the budget. So clearly, national insurance, the rate has gone up and the threshold is reduced. That's a very significant cost to community pharmacy. I was involved in a conversation with the Department of Health yesterday, trying to make the case for the NHS to help, or help fully with the cost burden that's been created by those changes. I think it's a hard fight really to get all of that money out of NHS. We're in the same position as the GPs and social care in pitching for financial support in relation to national insurance. I think we're going to struggle to get all of the money there, all of the refund on all the costs that have been incurred by the government's decision. National living wage going up from next April, having gone up significantly from this April as well. Yeah, that's an additional cost that everybody has to factor in when they're thinking ahead about selling and buying a business. The employment allowance, so that's something actually at the MPA we fought for very hard when it was introduced, because when it was actually introduced, community pharmacy was excluded, but we fought to get community pharmacy included. So that's now worth £10,500. So that's a buffer really for certainly smaller businesses against those additional costs from national insurance. With some changes to capital gains, but I'm absolutely not the expert on that one. I'll leave others to talk about that one. I think it's really important for anyone thinking about the community pharmacy market that 22.6 billion of additional revenue spend has been promised. So in comparison with 23-24, there'll be an extra £22 billion in 25-26. That's a very significant uplift. Now, some of that money has gone already because it's going to be used to deal with the cost of national insurance in hospitals. But there is a great opportunity there to make the case for community pharmacy to get some additional funding to stabilise the network with a fairer, better funding deal. And there's also a commitment to upgrade hundreds of GP surgeries, and that's linked to the neighbourhood health plan of the new government. So then, just to conclude, I suppose the environment for those exiting/entering the market, there will be uplifts almost certainly in 24-25 and 25-26. So the 24-25 uplift will come through retrospectively. I don't believe it's going to come through very soon. I think we are many weeks away from finding out. what that deal will be. But I can't be certain. These things change by the day. But you know, my guess at the moment is there'll be an announcement in a month or two, and perhaps that retrospective payment will hit before the end of the financial year. I think we'll hear relatively soon about the 2025-26 deal. We don't know we've got no indication yet what that is. So the first time in 10 years, we will have uplifts in community pharmacy, and we'll have 2 uplifts, 24-25, 25-26. I suspect they might be disappointing given the 40% real terms cut that we've had over the last 10 years. In that context, they'll be disappointing. It's difficult to know exactly what level they'll be pitched at the moment. We recently worked out that the 24-25 deal needed to be around about 7%, just to keep everyone in a standstill position, really, just because of all the inflationary pressures. But we'll hear at some point in the next month or two what that number is. Clearly, there are additional costs for everyone to deal with. I think the sector should be moderately confident about the 3 to 5 year time frame, because this new government is committed to doing a lot with community pharmacy. It's committed to expanding primary care, and that means giving a greater role for community pharmacy as well as general practice. I think this government believes in community pharmacy, but these changes and all the additional funding that will be needed, may not come through into more like the second half of this parliament. And that's why we're currently out campaigning for a better deal, and hopefully people saw the press activity today and the result of the MPA ballot. 99% of our members are in favour of taking action to really push the government to quickly come to the table with a fair deal and a proper uplift for community pharmacy that's desperately needed. But as I say, I think there's reason to be optimistic about where the sector will be in 3 to 5 years' time, and I think that's helpful if you're selling a pharmacy, and it's helpful if you're looking to enter the market to know that there is a positive future for community pharmacy. So thank you very much. Back to you, Sam.
Gareth, thank you so much. Let's catch up. Gareth, thank you so much. I'm so pleased that we had you on today. Your input contribution feels insightful, realistic, but also positive in terms of the kind of outlook for pharmacy, and really was interesting. So thank you for joining us today.
Pleasure. Thank you for inviting me.
We are technically 1 minute away from the show end, but there are some cues from the Q&A that I really would like to just try and get to. I think what we'll do you guys think it's possible? I know that you've seen the questions, and we've talked about the ones that we want to try and get to. Do you feel like it would be possible to give a quick answer to the 3 that we've discussed, and then we'll follow up perhaps with more detail afterwards? Is it possible that we maybe? I don't mind running a couple of minutes over, but not really more than a couple. What do you think, guys?
I can take the first couple of questions and answer them together as briefly and concisely as possible.
If you don't mind, just a quick answer would be great. And then I think was the other one we talked about was a legal question.
Happy to take that one as well, Sam, and I can.
If you don't mind, just kind of giving an overview, or if it is too complicated, just to say, look, actually, we'll pick this up afterwards. But I just kind of want to get these at least addressed. Is that okay?
Sure.
Perfect. Okay, so I'll just hand over straight to you, Atif.
Yeah, sure. So we had a couple of questions come in, related ones. One of our viewers asked, if you already go to a pharmacy by a limited company but want to buy another one, would you buy a new limited company or just buy shares using your existing company? And the second question on a similar kind of theme, I want to buy a 50% share in 2 pharmacies under one company. Should I buy the shares personally or through my already trading pharmacy? Now, obviously in our talk today, we talked about the different tax treatments of when you own things through a company and when you own them personally. But unfortunately, there isn't an easy answer for this one. It's going to depend on your circumstances. It's going to depend on how much you're buying the pharmacy for, what your plan is with it, how long you want to sell it in. And so it's really something that's going to have to be looked individually and answered there. So, yeah, that's all on that one. And I'll pass over to Reena.
Sure.
Very succinct. Thank you, Atif.
So this question was, if you are required to give an authorised guarantee agreement when assigning a lease, how can you minimise your liability? Or is there any type of insurance policy you can take out with a one-off payment to protect against this? So it's a really interesting question. The short answer is no, there is no insurance policy, unfortunately. If you have signed a lease where there is an authorised guarantee provision, it basically means when you assign it, you're still liable for the incoming tenant if they don't pay the rent. One way around it, the quickest way around it, is to get some sort of indemnity from the incoming tenant to say, look, incoming tenant, if the landlord comes after me because you don't pay your rent, then I'm going to come after you. And it's probably as good as it gets in a short answer.
But good also. I imagine that's something that you could help with if that was something that someone selling and using a car to bond wanted to put in place.
Absolutely.
Great. Okay, well, look, I will wrap things up there if everyone's okay to do so. Anything that didn't get answered today, we'll pick up afterwards with you personally. Thank you so much from ourselves at Hutchings Consultants, from Carter Bond, from Hutchings Accountants, and from the MPA. Thank you to all of our presenters. Your presentations today have really been interesting. So I'm glad that we did this, and I hope that it's been a learning experience for everyone tonight. Goodbye. Good night.
Thank you.
Thank you.
Thank you. Bye.